We begin with a Fox Business Alert, folks. Big changes in the richest people list. Elon Musk has blazed past Warren Buffett, and the timing could not be better or more reflective of a world in business and the stock market. On one hand, you've got this brash, cocky, impatient Elon Musk who wants to conquer the underground, the above ground. He wants to travel to outer space and make lives different from people living on different planets. And then there's the humble, folksy, extremely patient Warren Buffett, also known as the Oracle of Omaha. His investments firmly rooted in opportunities associated with daily habits of today. Listen, both are folk heroes to millions. For Musk, though, it's about defying conventional wisdom and the naysayers, which has a whole new crop of individual investors in this market saying the same thing. Now, the experts have been complaining about everything from central bank policy to trailing price to earnings ratios for missing the rally, while millennial investors are looking for ways to make money in this stock market and they're buying stuff that they believe in. They're not concentrated on old stodgy valuation metrics. I've been a fan of both Elon Musk and Warren Buffett. I've traded the way they trade and invested the way they both invest. But I think that this changing of the guard, so to speak, is absolutely fantastic. I want to get thoughts from Heritage Capital's Paul Schatz, along with Courtney Dominguez, Senior Wealth Advisor at Payne Capital. By the way, I'm not affiliated with Payne Capital. Courtney, I think it's such an amazing day with NASDAQ at a new all-time high for Elon Musk to pass Warren Buffett, who sat on $130 billion for almost all of this rally. You know, the differences, I think, reflect the differences in investing styles. Old Wall Street missing a rally, young millennials rocking and rolling.
Very much so. I mean, I think even anecdotally, I have my own friends and associates and all of those millennials where everyone thinks they don't have a lot of cash on hand. A lot of them do, and they are definitely interested in getting invested right now. So I really agree with your point that there, I think you're really seeing them come in. And Tesla is pretty interesting because it is very expensive. It's trading over 430 times forward earnings compared to the S&P 500, only 27 times forward earnings. But you do have a lot of kind of good signs, I think, in the short term. For example, there's a really big short squeeze on this. There's over $20 billion getting bet against the stock, and only a quarter of analysts who are rating it as a buy. That oddly enough is actually a good sign in the short term that it could probably go even further from here.
You know, Paul, just even speaking of PE ratios, I tell folks all the time, look at the end of the year, the stocks that did the best, they probably have PE ratios that the experts wouldn't have never touched. I just think there's something going on. Wall Street has been dissing it from the very beginning. The common refrain is, it's going to end ugly. It's like, come on, give me a break. There's something amazing happening here.
So you're right. So 2 points. One, valuation is probably the single worst timing tool on earth. Overbought markets get more overbought, and once they get expensive, let's not forget, value itself, the value sector has trailed the entire bull market. Value versus growth is probably about as cheap as it's ever been, but it's gone year after year, value has gotten cheaper and cheaper. So to use a PE ratio is nonsensical right now. Regarding Tesla, I'll be the Chicken Little. I'll be the other side. While Musk is a revolutionary and he's one of those rare people like Buffett, like Steve Jobs, like Bill Gates, personally, I just have a really tough time, and I've always, my whole career, buying stocks that go parabolic. And I'll even argue, and I'll go out on a limb and I'll say that today could be a peak for Tesla. I'm not dumb enough to say it could be the peak, but in order to short stock, the brokerage firms are charging usurious interest rates. I mean, I've seen things like 100%. It's almost impossible to get stock to short anymore. So that's usually a sign that a stock has gone parabolic, nobody wants to lend it out, and there's some kind of peak coming. It's just, I get why people are on board. I love the products, love them, but to have a stock go like that up, it's got to be up 70% in a couple of weeks. It's just not, for me, it's just, I'm way too chicken to venture there.
I got you. I got you. Now, I will say on last week, I said that we're going to see the mother of all short squeezes. Once they report on July 22nd and they're eligible for the S&P 500, I think this stock breezes past 2,000. It may come down sharply from there, but your point, and I think the shorts haven't gotten it yet with $20 billion, to Courtney's point, They've lost their shirt betting against Elon Musk. Hey, let's talk about what put that spark in today's session, because we were a little bit higher all morning, even though weekend. But news from Pfizer and BioNTech, both FDA approved for fast track on these COVID-19 vaccines. In fact, they're saying they're going to manufacture 100 million doses by the end of the year. So, I mean, Courtney, what does that mean if we do get this vaccine? And just by the way, Moderna, Novavax, BioNTech, these stocks are through the roof again today. So what does it mean if we get a vaccine, and would you be an investor in these names?
Yeah, a vaccine is only going to be a positive for the markets. I mean, realistically, things are already getting a little bit more back to normal. We're starting to see spending pick up. We're starting to see economic activity pick up a little bit here. And that's without a vaccine. So if we have that in the horizon, we see a light at the end of the tunnel, I think you're going to see a lot of that cash. I mean, remember, we have $5 trillion sitting in cash. Everyone got so nervous in March. And if they see that light at the end of the tunnel, I think you're going to see that all flood back in.
Paul, to that point, you know what? The casino names are through the roof. Penn Casino saying 90% of their properties are back online. Cruise ships have been doing well. I mean, how are you modeling your portfolio vis-a-vis a vaccine or not?
And the vaccine news has zero play in our portfolio. Look, to me, there's two reasons why stocks are rallying. Number one is that the stock market's discounting the reopening and economic activity 3 to 6 months down the road. And that's why you saw the peak on June 8th. And except for the NASDAQ 100, the rest of the indices have traded lower to sideways because they saw some stumbling blocks coming over the summer with the reopening. But the real reason is, let's face it, when the Fed is there with a nuclear bomb of liquidity, it is very difficult to have anything meaningful on the downside. And that's the number one reason how much money is available and how quickly can it get invested. So the vaccine news, yeah, I don't think the spike in corona cases, the markets don't care. On a health side, sure, but on a market side, it doesn't matter anymore.
Right.
And I think the vaccine, the market's discounting at least one, if not several vaccines being available by year end. But again, it's about this tsunami of liquidity available. And what you're seeing today and on Friday, perhaps another false start, but the small caps are starting to perk up a little bit, and the rally broadening out with the casinos. And this is what the market's been waiting for since it had the almost 10% pullback in June.
Well, you know what? That sharp pullback, we've been going straight up, and we're on the cusp of the S&P now breaking out. So I appreciate the points. Paul and Courtney, great stuff from both of you.
Thanks.
And that tsunami of Fed accommodation probably won't go away.